Well, a warm welcome everyone, and thank you for joining us today. My name's Carty from Solace Financial, which is a financial planning and wealth management firm based in Brisbane. Today we have Thomas King from Nanuk Asset Management. Tom joined Nanuk in 2009 and is a director of the firm's chief investment officer, and one of the portfolio managers with approximately 20 years of investment industry experience within the equity funds management space, investment banking, and private equity. He was previously an investment manager at Consolidated Press Holdings, an associate director with N.M. Rothschild & Sons, and worked as an investment analyst with Australian equities fund manager Herschel Asset Management. Tom holds a first-class honours degree in engineering from the University of Melbourne. Hi Tom, thanks for joining me today. It's been 12 months since our last vlog, and a lot's happened in that 12-month period. But could you provide our listeners with a recap on Nanuk's history and investment approach?
Sure, great to be back again. Nanuk runs a global equity strategy that's focused on investing in industries and technologies that are benefiting from long-term structural changes in the global economy, primarily related to sustainability and resource efficiency. So that covers everything from sort of clean energy technologies and energy infrastructure, through to healthcare technology and the industrial Internet of Things and the use of AI in business and industry.
Okay, very interesting space to be in. So how has Nanuk's investment approach evolved in response to the recent global developments, including the elections last year and the new tariff policies?
In a sort of broader picture sense, our approach hasn't changed at all. We do what we do, and that hasn't changed over more than a decade now as we've been running the fund. What we're trying to do is find good quality businesses in the industries that we focus on at points in time where the industry fundamentals or the profitability of the companies is likely to improve over the medium term, and then to buy them at valuations from which we expect to deliver upside for our unit holders. And so we're executing that approach in a pretty consistent manner over time. What the Trump election last year has done is created some significant dislocations in investment markets that have had some impact on our portfolio, but also provided us opportunities that have helped support pretty strong investment performance this year.
Can you talk us through those investment opportunities and how that's helped the sustainable business focus sectors?
Sure. So I think you can divide sort of Trump's policy impact into two parts. There's his big picture objectives that he's outlined in his campaign that he's following through on now, putting America first, enacting tariffs, deregulating in the US and dismantling bureaucracy and so on. And then there's a set of much more industry-specific policy objectives. And some of those are positive for things we invest in, and some of them are negative. So he's taken a sword to subsidy support for industries that he would describe as the Green New Scam, and that includes things like electric vehicles, renewable energy technologies like solar and wind. But he's also implementing a policy agenda which is intended to grow self-sufficiency in US manufacturing, so reshoring a lot of manufacturing into the US to develop more self-sufficiency in energy. And that's not just oil and gas that he's promoting, but other sources of electricity to meet rising demand, and to position the US for leadership in AI and things like semiconductor manufacturing. And so on one side you've got a set of industries that are being negatively impacted by some of the policy moves that he's made, but there are others that haven't. So we've seen opportunities in things like industrial automation, where companies will benefit from building out of more domestic manufacturing capacity, a lot of which will be automated in the US. We've seen beneficiaries in the semiconductor and AI space, where the US is now investing very heavily to try and maintain its leadership in those industries. And on the flip side, we've actually seen some very interesting opportunities in some of the areas like renewable energy, where policy impacts have been seen to have a an almost terminal effect on these industries, and share prices have fallen a lot. But our analysis suggests that actually those industries won't go away, and outside of the US will very likely continue to grow.
Well, with those changes, are there any specific regions or sectors you're avoiding or leaning into due to these geopolitical shifts?
There are. So we've been somewhat cautious about the impact of tariffs, which in a general sense we think is bad for everyone, including the US. And like in 2018 when Trump put tariffs on China, it's obviously bad for global supply chains, and a lot of the industries we look at have broad global supply chains. So industries like the automotive industry are particularly affected by that, and that's been an area until recently that we haven't had much exposure in. But as I said, the share price reactions we've seen have created some interesting opportunities in areas like the wind energy industry, where now Vestas, the leading ex-China global manufacturer of wind turbines, is one of our larger positions in the fund. And that's an opportunity that was created in the latter half of last year, where their share price fell to levels we haven't seen since early in Trump's first term, and was really being priced for their US business to stop completely.
Are there any other notable innovations or shifts in the sustainability space that are creating new investment opportunities for the portfolio?
I wouldn't say that there's many investable new innovations. There's certainly increasing amounts of investment in some new technologies like small modular nuclear reactors and nuclear fusion, but commercialisation of those technologies is a long way away. And the way that we invest, looking for good quality businesses, and by that we mean businesses that generate strong profitability on their assets and good margins, leads us away from looking at early stage companies that aren't yet profitable. So if you look at the way that the economy is shifting globally, over the coming decades you're likely to see a continuation of the trends of the last 20 years towards a set of technologies that in fact have been around for decades longer than that, but are becoming much more widely adopted as their costs come down. Mm-hmm. And so most of what we're investing in is the application of technologies that have been around for some time, but are going to grow much more quickly as they become cheaper, and as in some cases governments try and accelerate their adoption.
We've spoken about some of the impacts of the Trump tariff policies and what they've had on different sectors, but are there any other sectors or themes you're particularly bullish or cautious about right now?
We remain bullish about the adoption of AI technology, mm-hmm. and the fund does have a reasonable amount of exposure across quite a wide range of businesses that are benefiting from that trend, benefiting from the build out of data centres around the world, benefiting from applying those technologies in industries like software and services, and that is likely to continue to be an area of exposure for the fund. As I said, we're bullish on the outlook for investment in manufacturing capability in the US. I'm not convinced by the long-term sort of profitability of those manufacturing operations, but in the short term, companies providing the industrial automation type technologies will benefit from that. We've done well recently from exposure to the build-out of electricity infrastructure. So as the world's becoming increasingly electrified, as we're shifting from fossil fuels to electrification in the automotive space, in industry more generally, and now as you're seeing huge amounts of electricity demand from AI data centres, the demand for new capacity is very high, and that build out of additional transmission and distribution of technology, the use of technologies for stabilising grids, so things like battery energy storage and synchronous condensers and other technologies that they use to maintain grid stability as you're adding more renewables and building out more complex grids, is an area that I think will continue to benefit. Where we're cautious, I guess if you look big picture, the global economy has actually been quite weak for a while now. The US economy is weak, the European economy is weak, the Chinese economy is weak. I think notwithstanding the potential impact of the uncertainty Trump's creating and the tariffs, there's a good chance that you see a lot of industries starting to recover, and where we're being cautious but see opportunities in some of the industries that are still recovering from what happened during the COVID period. So if you look at something like healthcare technology, there was huge shortages of certain types of healthcare technology during the COVID period, huge amounts of investment and buying during that period that's led to excessive inventories and then a big slowdown for the companies providing those kind of technologies. And that's yet to recover, and we see opportunities in areas like that where valuations are at historically low levels. The industry is somewhat stagnant as it's dealing with these sort of industry level issues that are playing out over several years, but eventually things will pick up and normalise, and we see some good opportunities in areas like that.
Okay. Well, Tom, we've covered a lot of ground this morning. Is there anything else you'd like to add?
Look, I think that the interesting thing for us is the misconception that because Trump's policy agenda is overtly negative towards a small number of the sustainable technologies, and certainly towards decarbonisation and climate policy, that investing in anything to do with those would be a bad thing to do now, would be a foolish decision. And in fact, if you look at the way that markets behave, arguably the complete opposite is true. So the policy agenda this time is being prosecuted in a much more aggressive way, but it's not dissimilar to his policy agenda in his last term, and very different from the Biden era which provided enormous amounts of subsidy support for sustainable technologies. But if you look at the way that that equity markets behaved during those periods, sustainable technologies did extremely well during Trump's first term and extremely poorly over the duration of Biden's term. And that's not what people would expect to see.
Exactly.
And it's a phenomenon that is sort of academically well understood about how people's expectations of the future change during terms of government in democracies. And we're seeing that play out in real time, and what it means is that we have a set of opportunities now that are very attractively priced in an historic context because of the underperformance over recent years, and that's been exacerbated in the short term by Trump's policy agenda, but we're seeing opportunities at prices that we haven't seen for 7 or 8 years, and there's a very good chance that that pattern will repeat itself, and notwithstanding the agenda that Trump's pursuing, that investments in areas that are counter to that may end up doing very well over coming years.
Okay. Well, Tom, I appreciate you making the time to talk with us today.
Pleasure.
Thanks again, Tom. I really enjoyed our conversation and found it incredibly insightful getting an update on the sustainable investment space.